So welcome class. This time we are going to look at question 3. Question 3. ATD May 2021 paper. Question 3. Summarize two differences between debentures and equity shares. Summarize two differences between debentures and equity shares. Summarize two differences between debentures and equity shares. So welcome. Summarize two differences between debentures and equity shares. This is question 3, ATD, May 2021. Two differences between debentures and equity shares. Now there are so many differences. We might not even talk about two, but let me just list what I can list. So debentures, number one. A debenture is a document. A debenture is basically a document that acknowledges a long-term loan. A document that acknowledges a long-term loan. So we normally say that a debenture is a long-term loan. And being a loan, it simply means that it adds up to the debt part of the capital structure. It's a debt to the company. And so it's a liability to the company. And it attracts what? Fixed interests. It attracts fixed interest. Any loan attracts fixed interest, whether the company makes profit or not. Whether the company makes profit or not, it has to be repaid. So it's paid by the company whether it makes profit or not. It's a loan. It attracts fixed interest. And these are not, the owners of debentures are called debenture holders. Debenture holders. They are not the owners of the company. They are not the owners of the company. They have only allowed their money to be used in the business in expectation for interest at the end of an agreeable period of time. So since they are not the owners of the business, they cannot control the business. They cannot control the business. They don't have voting rights. They don't have voting rights. Voting rights. They don't have their voting rights. And in most cases, their risk is covered by what? By the securities or collaterals. Security or collateral. So it's not that very risky. Of course, there exists a risk of non-payment, but it's mostly covered by collateral. Okay, on the other side, let's look at the other side. Equity shares. Equity shares forms part of the main capital of the business. It's the main capital of the business, and it is contributed by the shareholders. We call them the ordinary shareholders. These are the real owners. Ordinary shareholders are the real owners of the business. Real owners of the business. Real owners of the business. So real owners of the business contribute capital in form of equity. And that's what we say equity share. So a share is a unit of ownership. A unit of ownership. A share is a unit of ownership. The holders of this are called ordinary shareholders. Ordinary shareholders. Ordinary shareholders. And these people, they earn what we call dividends. They earn dividends. Ordinary dividends are that, unlike these ones who you can see, their benefit is on fixed interest. So they earn dividends, and these dividends are variable. They are not fixed. The dividends are variable. It depends whether they are going to make profit or not. So if they make profit, they earn dividends. If they don't make profits, then they don't earn any dividends. That means that it's very risky. It's very risky to be an ordinary shareholder, but at the same time, the returns can be so good if the business is making profit. So very risky because the investment cannot be secured with collaterals like the debentures. Debentures, we've said, chances are very high that the amounts that they have advanced the business will be secured by the collaterals that belong to the business. And in any case, if dissolution occurs, then these will be the last people to be compensated in case anything, in case the assets of the company possibly reach where they are. Otherwise, they stand a chance of losing everything. They are the last ones on the list. So it's very risky, and they carry the voting rights. That means that they can make decisions. They can make decisions on behalf of the company. They have the control powers. They have the control powers. They have voting rights. I think these are more than enough. And we say they are called shareholders. These are more than enough. The question only wanted two differences. I think you can pick more than enough. These are more than enough. So we also have preference shareholders, but I'm not talking about preference shareholders. Preference shareholders also have allowed their money to be used in the business. They are part of the shareholders, but you know, these ones are a bit different from the equity because they don't form part of the real core capital of the business. And of course, they also earn fixed dividends, unlike the ordinary shareholders who earn variable dividends. And these ones also can't make, don't have voting rights, no voting rights, no voting rights, not as risky as the ordinary shareholders, no, and it goes like that. But the interest of this question is on the difference between debentures and equity shares. Equity shares, when somebody just talks of equity shares, what should come into your mind first thing are the ordinary shares, and ordinary shares capital by the real owners of the business. They are quite risky because they are the last ones when it comes to consideration when it comes to dissolution. They enjoy voting rights. They have control of the company. They enjoy dividends, variable dividends. That means they have a chance of making very good returns if the company is doing well. And of course, they also form the real owners of the company. So those are I think those are more than enough. You can get the points that you want from there, and you can also read in advance. Let's go to B. The following information was extracted from Ledger of Karanja Traders as at 1st October 2020. So land, buildings, fixtures, allowance for doubtful debts, accumulated debts, trade receivables, prepaid expenses, trade payables, and accrued expenses. You can get this question paper, just download. It's here with us so that it can guide you. During the year, motor vehicles which had cost 15 million and which had a net book value of 3 million was sold for 4.5 million. During the year, motor vehicle which had cost 15 million and which had a net book value of 3 million was sold for 4.5 million. Depreciation is yet to be provided as follows. Buildings, straight line method. I think there was a rate also. The more reason why you need to download this piece of question, you need to have your question. I have mine here. Fixtures and fittings, 25% reducing balance. Motor vehicle, 20% straight line method. No depreciation is charged on land. And then trade receivables of 1340 are to be written off as bad and doubtful debts. Are to be written off as bad, and the allowance for doubtful debts is to be adjusted to that so that it is 5% of trade receivables. So required. Prepare the following ledger accounts for the year ended at 1st October 2020. Bad debts account. So we are supposed to come up with a bad debts account. Bad debt, this is the question. So let's just go to bad debts. Trade receivables of 1340 are to be written off as bad debts. That's the only statement on bad debts. So we prepare bad debts. Allow me to prepare it here. I can see there's a lot of space here. So allow me to just come up with these accounts here. So bad debts. Just open an account. It's a simple account like that. And call it bad debts account. Bad debts account. This is credit side. This is debit side. So bad debt is the loss to the business, and losses are on the debit side. Losses are debit entries. So simply come here and say bad debt account, bad debt account. So we want to create this bad debt, bad debt, bad debt. So simply come here and say bad debts. Remember, the two accounts that are affected are going to be bad debt and the accounts receivable. Accounts receivable. So we have accounts receivable, debit and credit. Here we have the debtors amount. So bad debt is supposed to reduce on the debtors. So we are going to credit the debtors account. Credit the debtors account and debit the bad debt account. So here we'll say accounts receivable. Accounts receivable. How much? The amount is 1340. So debtors is a debit account, but because we are reducing this, we will credit the debtors account. The reason will be bad debt account. So we come here, bad debt account. We show the reason for this is accounts receivable. So we'll have it like that, and then we simply close because there is no any other transaction. 1340, like that. And then here we also close 1340. The side with the highest figure is always the balancing figure. And then we say to P and L, because this is a loss and losses go to P and L. And we put this figure here, 1340,000. So P and L, when it goes to P and L, it will assume the debit side. You can see it's on the credit side. So it goes to P and L, automatically it assumes the debit side, and that explains why it's found on the debit side, under expenses and losses, debit side of the P and L. So this is how this account will be. We are done. So we are supposed to debit bad debt account, and then credit accounts receivable, This is the treatment, and that's what we've done. We've credited accounts receivable and debited bad debts account, and then closed the entire ledger. Thank you. That should give you the 2 marks. I think it's 2 marks. Simple as that. Then let's go to allowance for doubtful debts. Allowance for doubtful debts. So we'll also open it here. Allowance for doubtful debts. Again, we'll have it like that. This is debit, this is credit. Let's see how it goes. So, allowance for doubtful debts. We already had the allowance for doubtful debts, 2570. It's a credit account. So, this is already the allowance for doubtful debts, and it's normally a credit account because it has that effect on the debtors. So, allowance for doubtful debts, 2570. So, this will be our balance brought forward. Balance brought forward will be 2570. So, on the credit side, because it reduces our asset in the debtors. And then what are we supposed to do? Trade receivables of 1340 to be written off as bad, and the allowance for doubtful debts is to be adjusted so that it is 5% of trade receivables. So let's look at 5% of trade receivables. This is 0.05 times trade receivables. What is the figure for trade receivables? 66,000. So times 66,000. This gives us 3,300. Okay. So what are they saying? 3,300. The balance for doubtful debts is to be adjusted so that it is 5% of trade receivables. Is to be adjusted so that it is 5%, which is now 3,300. So it needs to be adjusted to get to 3,300. So let's just get the difference. 33 minus 2570 minus 2570. That is 730. So it means we are supposed to adjust it by 7,000. And we are simply increasing. So we'll simply come here and say, since we are increasing, in fact, let's just come here and say balance carried down will be 3,300. We are moving from this to this, moving from 2570 to 3,300. At the end of the year, it has been adjusted to 3,300. So when we close the books, we will have 3,300 and 3,300, like that. The difference, which is now 730, will come in as, we say, to P&L account. Now this was an increase, and you can see where it is. It's on the credit side. So when it goes to P&L account, it assumes the debit part of it, and so it will appear as a loss to the business. So that's how it goes. We are done. So we started with this. We are closing with this. We adjusted to this. So the difference is what we'll send to P&L, and increase is always posted to the debit side of the P&L. If it was a decrease, it will have reflected on the credit side of the P&L. Okay, so we are good to go. Let's go to number 3. That is auto 2 marks. Asset disposal account. So asset disposal account. Asset disposal account. So debit, credit. Asset disposal account. Asset disposal account. So this is the asset that was disposed of during the year. During the year, motor vehicle which had cost 15 million and which had a net book value of 3 million was sold for 4.5. So motor vehicle is 45 million. This figure here is 45 million. But part of this 45 million, we had 15 million. It's this that was sold. So during the year, motor vehicle which had cost 15 million and which had a net book value of 3 million was sold for 4.5. So we are supposed to come up with asset disposal account. So let's look at that asset disposal account. So what we'll have is the asset itself. So balance brought forward, which was 15,000, or 15 million at that. Let's talk of 15,000 because we are restricting the zeros. So 15,000. Then had a net book value of 3 million. So it means it had an accumulated depreciation of 12 million. Accumulated depreciation of 12 million. And then the disposal cash account was 4,500. Cash account was sold for 4,500. Yeah. So initially the value was 15 million. It had depreciated by 12 million. So the net book value was 3 million. And then it was sold at 4.5. So then we get the total here. This is 16,500. This is 16,500. This gives us 1.5. And this is to P&L. To P&L account. So it goes to P&L. You can see it's on the debit side of the asset disposal account. So to P&L it goes as a credit. And that explains why it's considered as part of the income and gains in the P&L. So it's on the debit side. When it crosses over to the P&L, it assumes the credit part of the P&L, which is the income and gain. So this transaction has simply led to a gain of 1.5 million. Okay, let's move on. We go to the next question. Accumulated depreciation. Now these are 3 marks. Accumulated depreciation, land and buildings, accumulated fixtures. I'm saying 3 marks because it's a repetition. The concept is the same. So accumulated depreciation accounts. Accumulated depreciation, land and buildings. The concept is the same. credit, debit. So accumulated depreciation. But remember also, if you fail all of them. So it's quite tricky. Land and buildings 120,000, but we are interested in it's the accumulated depreciation account. So we'll start with the figures are here. Accumulated depreciation, land and buildings 16,000. So that's where we start from. We say balance brought forward 16,000, and then we add the depreciation for this year. Depreciation, is it a credit account or it's a debit account? It's a credit account because it reduces the value of the asset. So it's a credit account. So depreciation for this year. Buildings, let me just confirm the percentage because it looks like this question. So this is the original question. I just want to get this part. So buildings is 2%. Buildings is 2%. Buildings is 2%. So let's go back and continue with what we are doing. Buildings 2%. So this is 2%. So 2% straight line method, it means if it's straight line method, it means we just take 2% of 80,000. That's all. 2% of 80,000 is 2% of 80,000. It will be 0.02 times 80,000. That should give us around 80,000. That should give us 1,600. So depreciation for this year will be depreciation will be 1,600. Depreciation for the year. Actually, we don't write here depreciation. We write P&L because this figure will go to P&L. So P&L account 1,600. Then we close the books. So this is 17,600, 17,600. Then 17,600. This becomes our balance carried down. So balance brought down will be 17,600. So this 17,600 is what will start with the following financial period. But for now, we started with this, and then this is the depreciation for this year. So total when we are closing the year, we have 17,600, and that's the same trend now for all the rest. So we come here, we have accumulated depreciation account. For what? Now this is it motor vehicle? For fixtures and fittings. Fixtures and fittings for 4,000. So fixtures and fittings. So balance brought forward is 44,000. Then we calculate now the depreciation for this year, which will now go to a P&L. And you can see it's on the credit side here. So when it goes to P&L, it assumes the debit side. So P&L account, how much? This is now 25% of. Now, realize the method is reducing balance. How do we work out that? If it's reducing balance, we always take the value, which in our case is 88,000, minus the accumulated depreciation. Accumulated depreciation is 44,000. So this gives us 44,000. And then we work out 25% of 44,000, which will now give us 11,000. So when we talk about reducing balance method, we work out the percentage of the written down value as at that particular time. The book value of that item, the net book value of that item that time. And when we just talk of straight line method or on cost, it is the original, the historical cost of that item. So reducing balance, you can see this is the cost minus the accumulated depreciation all those years. We get the net book value. So we work out 25% of the net book value, which gives us 11,000. So we'll come here and say P&L 11,000. This is the depreciation for this year. So we get the total 55,000. 55,000. This is the balancing figure. So 55,000 will be our balance carried down. This is what we are going to start with the following here. Balance brought down 55,000 like that. Then we come to the next one, accumulated depreciation. I told you now this is the, so here we have, I think, motor vehicle, if I'm not wrong, motor vehicle. So motor vehicle again, what we started with accumulated depreciation, 27,000. So 27,000. So we'll say balance carried, balance brought forward, sorry. Balance brought forward, 27,000. And then P&L, that is the depreciation for this particular year. The assumption here is that we have the asset, not necessarily even the assumption. This is what is happening. The asset account is a positive account. Depreciation will reduce it. Depreciation will reduce the asset. So we normally say when you have depreciation, you debit the depreciation account. Sorry, you debit the which account? Depreciation, because we are going to credit depreciation account. So debit P&L account and then credit the depreciation, accumulated depreciation account. Yeah, we credit the depreciation account. You can see we are crediting the depreciation account and then we'll debit now the P&L account. So let's come back here. What is happening here? Motor vehicle, 27,000. We've captured that. I think we've captured that, 27,000. So P&L account. This is a motor vehicle, 20% straight line. So straight line, we just go straight to 20% of the original cost. The original cost is 45,000. So 20% of 45,000. This should be able to give you 9. Is it 9,000? Yeah, 9,000. 20% of 45,000 is 9,000. So you simply come here and write 9,000. Then let's get the total. This is 36,000. This will be 36,000. So we say balance carried down 36,000. Balance carried down 36,000. Balance brought down 36,000. So that's how we go about it. 36,000, 36,000. That's how we go about it. So I think everything is all perfect. We should have covered everything. Yeah, accumulated depreciation. Yeah. So always remember, reducing balance method, get the cost minus accumulated depreciation before you can now subject it to the percentage depreciation times the percentage depreciation. But this one, just take the percentage of the cost because it's straight line method, and this was also straight line method, percentage of the cost. Whenever we talk about straight line method, same percentage of the cost. When you talk about written down value, when we talk about reducing balance method, it is percentage of the written down value. So that is the difference. And I think we are good to go. This was a fairly good question. Let's meet in the next question. Thank you.